Traditional rentals in Florida, they're getting squeezed right now by rising costs, inconsistent maintenance, and higher turnover. And what we're seeing that build to rent, those new construction rentals designed specifically for needed workforce housing, are avoiding these problems because the product is uniform, easy to operate, and getting the results people want. So, of course, families want a home that feel like they're not a burden with the ownership. And that's why a lot of people are turning to rentals. And so if they're going to stay in an old traditional rental where it's an older 50, 60, 70-year-old home or a more expensive home that they can't afford, there's becoming a gap right now. See, families are not staying longer in these fixer-up rentals, and they can't afford the more expensive rentals of properties that people never wanted to even intend to be rentals, or they thought they could gamble their way forward, that they could put the money down, lose a couple hundred, even a few $1,000s a month to make up for it in equity growth. And that's a recipe for disaster. It's not investing, it's gambling. And we're watching that happen. The tenants are what decide whether a property is worth its money. In fact, I think it was Warren Buffett who once said, a property is worth what it can rent for. That's when you look at it purely from the financial aspect. And a lot of properties, again, traditional ones, are getting hit with incredible issues, especially here in Florida, which I'm going to talk about, and others are getting a pass. The new construction get a pass from certain things of interest rates, of things like higher insurance costs, of higher turnover, and higher maintenance and repair. So let's break that down. So traditional rentals, let's talk about what traditional rentals are. So for me, this is old fixer-upper homes, 70, 80 years old, that are just what they are. I own some of these properties. I've owned hundreds of these properties, and they are good what they're good for. But again, there are going to be some things that you cannot change. One, higher maintenance and repairs. I call it the 3-year curse. Once you get into these properties, I knew after owning them a few years that my maintenance and repairs would normally skyrocket quite a bit after year 3. It's just something that happened. Us experienced investors would call it the 3-year curse. Now, this is okay if you write it into your pro forma and your numbers, but a lot of the times you don't. In fact, normally a lot of people who are being pie in the sky are looking to keep those repairs numbers at what a new construction would be at or even lower. Obviously, this feels good to have on your pro forma and see what you might make, but things will end up not being so. You want to avoid this with all costs to do your pro forma wrong, because you're going to just cheat yourself. These older traditional rentals, again, older fixer-upper homes, some of them haven't even been completely fixed up. These are going to have higher maintenance and repairs. They can also have more issues with the turnover. So when I used to do this, and this was something that was a complete surprise, about a decade ago, we started doing the new construction instead of the old fixer-uppers. And after about 5 years, we did a test, and it was very interesting. It was about 2,000 old construction properties that I compared it to over 2,000 new construction units. On those newer units, we had a stay rate of just over 3 years. With our older traditional properties, we had a stay rate of just about a year. So again, we tripled our occupancy time with that first tenant, which is so key because you avoid turnover costs, you avoid more maintenance and repairs normally as well because a tenant's staying longer and treating the property better. So this was absolutely key. This will eat things up on the traditional. Now, there's two types of traditional again. There's not just the traditional old fixer-uppers. There are also nice, new, fancy houses priced twice the amount of the median for the area. We're seeing a lot of properties be turned into rentals right now because people are stuck in them. They bought really nice houses, let's say in Jacksonville here, for $500,000-$600,000, promised by their realtor that they're going to go up even higher in value. You're getting the low interest rate. This is great. Now they're stuck. They can't sell the property. They're upside down. They're losing money, and so they're trying to just rent the property. Problem is with these nice new properties, yes, you're going to have probably lower maintenance and repairs, but you're going to be losing money right off the bat because even without maintenance and repairs, you're upside down. The rents do not follow up with those properties the way that they do. As in fact, in almost all markets you watch, once you start to get above the median, you'll see a trail off of the rents not continuing to follow. That's a very serious issue when you're trying to cash flow a property. And these now traditional properties in nicer areas where people are stuck in them, they can't sell because they're going to sell to someone who doesn't want it at the price they're trying to get. And they are going to be locking at an interest rate sometimes double what these people are locked in at. So it doesn't make sense for them to buy. So these are becoming a huge issue compared to the new construction turnkey rentals. Again, these build-to-rent properties are built specifically to rent. Now, they are retail worthy and you can sell them retail, but they're being built just below the median value for the area. This, again, got left behind in supply during the huge run-up, especially here in Florida. Everyone was focusing, especially the builders, on these big, fancy houses. This is what the realtors sold because they made bigger commissions. But right now, these are not in demand, and the stuff that was left behind is still being built, still being filled, still cash flowing. So this is something that you want to look for. There is a huge, huge difference for new construction rentals in the workforce housing realm. There's a shortage. In fact, right now, we're building in about 9 different markets for institution buyers, over 200 units each, smaller single-family homes, townhouses. These are in high demand when other build-outs of where these realtors and builders were focusing on, these higher-priced homes of twice the value for the area, they're not doing well at all. Yet, they're trying to bring everybody else down. It's pretty interesting. They're saying Florida's dead, there's problems. The question I always say is, why would then there be more and more money being put into these types of properties? Now, a lot of the builders in these fancy houses, 500, 600,000, for example, in Jacksonville, they're not building these anymore. They've pulled back. They're sitting on the sidelines. But builders who can find the more affordable things for half of that, sometimes even less, they're still building because there's that workforce housing demand, and you can get different incentives with these. And let's talk about those incentives. First one, insurance. This is absolutely huge. Insurance companies are incentivized to give lower rates to properties with less risk. These guys are analyzing risk to such a high degree, it makes my head spin. This is what they do. They're all about analyzing risk to make us pay a certain amount of money to cover their risk. When they get one of these old traditional homes, it's going to have a higher risk. Again, a lot of these homes built in the 50s and 60s, well, they were built on lower ground, a different structural design. They've had more turnover, more risks in certain areas of such. And so the insurance can be higher, especially if you're near the beach. I mean, again, in my personal home right here, my home sits high and dry at 15 feet above sea level, right next to the ocean, but little beach cottages right down the road on our barrier island, they're at about 3 feet. And their insurance is 5 to 7 times more, even though their house is 1/3 of the size. I mean, think about that for a minute. These are the things you have to look for. If you're going to an old traditional property, it's on low-lying ground at a lower structural design, you could be paying a huge insurance premium on that to cover their risk, and that eats right into your cash flows and the numbers making sense. The problem that we're seeing, again, the difference between these old traditional properties and the new construction is they're making it sound like their insurance premiums are the exact same. That's just not true. You got to look at your pro formas and get the actual quote from the insurance company. But when you do, you'll probably be able to look at it and see a huge difference like we have. Again, remember, I used to do a ton of these fixer-upper homes, changed our ways about 10 years ago, and I'm glad we did because the new construction really does capitalize on this incentive of lower insurance costs, which leads right to your bottom line. Now, the next incentive, mortgage incentive. This is huge. Again, when I went into real estate investing years ago, my first teacher always said, you got to either get cash or terms, either a good price or good terms on the property. And as long as you can get one of them, as long as you're an astute real estate investor, you can make that a good deal. I am baffled right now to watch so many people actually trying to discount builders for offering great mortgage incentives. This does not always happen. And the fact that you can get incredible terms, you can get on a new construction home that's in the affordable range where there's not a lot of supply of it, you can get a mortgage rate that was back available in 2021. I mean, when you think about that for a minute, that's insane, especially when you do the numbers. When you get your pro forma down down, when they're buying down the rate for you on a long-term rate, then you can get an incredible cash flow right off the bat. And some realtors are saying, yeah, but the price is too high. The prices are where they are for the affordable markets. Again, these are appraising and in high demand. So as long as you're not overpaying, but paying market value, and you're getting this type of rate, and your main goal is long-term growth and cash flow, this is an incredible opportunity. In fact, you've never seen builders being able to do these builder forward commitments this level and so available. That's just not happened, and it will not always happen. In fact, it's going to be interesting to see when the supplies continue to go down. And again, we've predicted this. You look at that chart of when starts in June of 2022 just plummeted. All of these starts and all of the permits just stayed on the sidelines. We are going to go into a supply shortage in many of the growth markets in Florida and other areas of the Southeast. At least that's what the experts are saying. And when we do that, that's going to show quite a pressure on the rents, which could actually improve the cash flow. So if people are not getting in now, they'll also never be able to get in because they won't have to offer. Builders won't be offering in another year these types of rates. And everyone says these rates of 2021 are not coming back. I agree with you. So if you're looking long-term and you can get into that rate, short-term values, even if values went down 5 to 10%, but you're holding through, then you are in a great long-term position that many can't get. And remember, although builders are offering it more, not all builders can get this mortgage incentive. So if you can get a real build to rent new construction builder who can actually qualify, because in order to do this, you have to walk into the bank and show your balance sheet. And if your balance sheet is not strong enough, the bank will not allow you to buy down the rates for your clients. So we're in a lucky position, for example, where we're backed by an incredible large group out of Japan, Sumitomo. So our balance sheet is very healthy. We have no bank debt. And so we're able to qualify for these things because the bank feels safe with us and pass those savings on to our buyers. And when you're having lower insurance costs and lower mortgage rates, you are hitting two of the main incentives that determine whether a deal makes sense or does not make sense. Now, if you're looking to buy a home and resell it in a year, that's what I consider a flip. This is not investing. I look now 10, 20, 30 years at least with my rental properties. And if you're looking that way, then you'll be able to see that these incentives are not only important, but they are the make or break whether you make money in the future or not. So, why are you buying property? This is the question you have to ask yourself. If you're looking for it to go up in value in a short 6 to 18 months and try to flip it and make money, then good luck. That's not investing. That's what I consider gambling, and it could work for you. I wish you well. But if you're looking to truly be an investor and invest long term, the investors that I work with, they start with finding a good, solid property that has cash flow. Now, as you know, I've always said I will absolutely sacrifice some cash flow for a better quality property, but I want it to have some cash flow. And if I can start today, any day that I can buy a property and start with cash flow and good terms in place, like a long-term mortgage, and look out long-term, not 12 months or 18 months, but I like to look 5, 6, 7, 12, 15 years, then I know that I'm planting a seed for success in the future. What is your cash flow able to do today? If anyone says to you, oh, that doesn't mean anything just because you're cash flowing it today, it does mean something, especially if you can get a new construction, fully warranted property that cash flows today, is priced below the median value for the area. You're going into a protection zone that's shown to hold its value in tough times and also accelerate its value in good times. And why? Because a lot of builders won't build there. So no, if you're looking at old traditional, there's going to be more of the old fixer-uppers out there. There's going to be more of these bigger, fancier houses priced twice of the median that all the realtors were pushing to people back in the 2020, 2021 days. And those numbers don't make sense. They're going to put you in trouble. They are emotional buys, and you are going to lose money every month. You may make up for it in growth over the next 5 to 10 years, yes, but you need to be able to hold on then and feed that every month in, month out, year in, year out. I don't recommend that. I'd rather have some money coming in with good fundamentals around it to help you grow. Also, you don't want to try to grow with old traditional properties if the turnover is more and those turn costs are much higher, and the maintenance and repairs has more surprises and higher costs. That too is going to sink you in those starter years where it's so important to get things off on a right trajectory. So traditional is going to have higher risk. Again, this is old fixer-uppers or bigger, fancier houses that are becoming rentals by mistake. They're priced twice above the median and they are not working cash flow number-wise. And again, there's other things. Mortgages, you can't get the lower rates on these. You can't get the lower insurance costs on those old fixer-uppers. So look at what makes sense. Why would builders still be putting money into the market if they're not in demand? It doesn't make sense. That's why all the big fancy builders and those bigger houses have closed off. Look at where your numbers are going to be. This is absolutely key to know whether you should buy or not. And the biggest mistake you can make is staying on the sidelines for the next 5, 10, 15 years. I've known investors that I've gone to classes with. They are always about to do their first deal. They didn't buy a traditional or a build to rent. And so either one would have done them better than staying on the sidelines. But if I had my choice today, and we've made our choice because I'd hung up my rehab shoes 10 years ago with those traditional properties, is going new construction, build to rent. The fundamentals are stronger. The numbers are given more incentives, the mortgages, the insurance costs, and that goes to your bottom line and gives you a better trajectory to make sure that you can make money with less headaches and more time to do the things that you want to do. So overall, build to rent is not a trend. It's here to stay. There are way too many people getting into it. We have over 7 million houses in shortage in the U.S. today. The majority of those, you guessed it, are those affordable workforce housing priced below the median. Someone's got to step up, and it's going to take years to do that. This is not a trend. It's a structural shift in how families want to live and how investors can make proven returns. So if you want to protect your returns, step into the game when other people are telling you to be fearful, but you should be stepping in with confidence. Watch some of the next videos because I'm going to show you what's happening in 2026 to make money and do it with less headaches.